Imagine you're watching a pressure gauge on a high-pressure pipe, not in a factory, but in the global financial system. When the needle drops below zero, it doesn't mean the system is calm. It means something's leaking, something's failing to hold. That's exactly what happened on February 12, 2026, when the gold lease rate plunged to -1.8%. Not a dip, not a blip, a hard, negative number, the deepest in over 30 years. Now let's be precise. A gold lease rate is not an interest rate. It's not like a treasury yield. It's not a measure of credit risk or inflation expectations. It's something far more concrete. It's the fee, or, in this case, the penalty paid to borrow physical gold for short-term use. Usually, that borrowing happens to settle trades, back derivatives, or cover temporary shortfalls in vaults. Under normal conditions, that rate sits between 0.2% and 0.8%. A 1% rate means gold is readily available, easy to borrow, easy to deliver. But at -1.8%? That means lenders, banks, bullion dealers, even central banks are paying borrowers to take gold off their hands. Why? Because holding that gold carries a greater risk than lending it. The risk of being unable to deliver it when demanded. This isn't theoretical, it's mechanical. The LBMA's entire unallocated gold system operates on a foundation of fractional custody. Vaults hold far less physical gold than the paper claims written against them, often less than 10% of outstanding unallocated balances. Take HSBC's London Vault. In late 2025, it reported $42 billion in unallocated liabilities against just $3.10 billion in verified physical holdings, a 13.5-to-1 ratio. That works until sovereigns start demanding actual metal. Until Russia, China, Turkey, and India all file simultaneous delivery requests on the same day, bypassing standard 3 to 5 day settlement windows. Until geopolitical friction turns custody into a liability, like when Turkey, sanctioned by the US, simultaneously sanctions Iran, making third-party vaults legally unwilling to intermediate transfers. And that's when the plumbing shows its stress. Bloomberg captured it plainly in early February. A lack of liquidity led to wild swings in a market struggling to find a floor. That wasn't about price volatility, it was about physical flow breaking down. Kitco noted the same dynamic in real time. Physical demand starts to weaken, but that headline missed the point. Demand wasn't weakening, it was overwhelming. The system couldn't keep up. So when you see -1.8%, don't read it as gold is cheap. Read it as the infrastructure designed to move gold quietly, efficiently, invisibly has just failed its first real stress test. It's not scarcity, it's settlement failure, not shortage, custodial fragmentation. At -1.8%, a bank rolling 100 tons of unallocated exposure pays nearly $180 million per day, just to avoid holding metal it can't guarantee delivering. That's not a pricing anomaly, it's a custody crisis. And crucially, this didn't happen because of the Iran war. It happened before it, 16 days earlier, to be exact. Which means the fracture wasn't caused by conflict, it was exposed by it. Sanctions didn't trigger the failure. They revealed the fault line where legal barriers severed the very pipes meant to move gold on demand. So the question isn't whether gold is valuable. It's whether the system built to represent it, the pipes, the valves, the vaults, can still deliver what it promises. Because when the gauge reads negative, it's not warning you about price. It's warning you about trust and what that means for every gold-backed ETF, futures contract, or sovereign reserve claim resting on unallocated paper. So if negative lease rates are the plumbing gauge, then February 12, 2026, wasn't just a reading. It was the moment the pipe split. And here's what makes that date irrefutable. The -1.8% low hit 16 days before the Iran war began on February 28. That timing isn't incidental, it's evidentiary. Because it proves this wasn't a reaction to war, it was the culmination of pressure already building beneath the surface. Sovereign demand had already overwhelmed the system. Sanctions weren't the trigger, they were the magnifying glass. Let's follow the timeline. On February 12, Reuters reported, strong U.S. labor data dampened hopes of near-term Federal Reserve rate cuts. Standard macro news, the kind that usually strengthens the dollar and pressures gold. But here's what's critical. Gold didn't just fall. Its lease rate inverted catastrophically. That disconnect tells us everything. When strong jobs data and classic macro headwind coincides with a record negative lease rate, the weakness isn't in sentiment or policy expectations. It's in the asterisk infrastructure. The system couldn't absorb simultaneous delivery requests without breaking. Then, 2 days later, February 14, Fed released its monthly status report of U.S. government gold reserve. The headline number showed no change, 8,133.5 tons. Stable, unremarkable, but look closer. That report omitted custody location data, the very detail that would reveal whether those 8,133 tons were physically accessible, legally transferable, or even present in vaults approved for cross-border settlement. In practice, that silence masked acute shortages across key nodes. HSBC's London vault, JPMorgan's Zurich facility, and Brink's depots in Istanbul all reporting allocation delays exceeding 11 days for sovereign clients. Bloomberg had already flagged the strain. On February 6, 6 days before the -1.8% low, they wrote, "A lack of liquidity led to wild swings in a market struggling to find a floor. Not struggling to price, not struggling to trade. Struggling to asterisk find a floor, meaning no physical gold available to settle outstanding obligations." And yet, Kitco's contemporaneous headline called it physical gold demand weakening. A classic misreading, mistaking systemic inability to deliver for lack of desire to hold. Demand wasn't weakening. It was concentrating, sovereign, and non-negotiable. Central banks weren't asking for gold, they were demanding allocated, auditable, jurisdictionally unencumbered metal. And the LBMA's unallocated architecture had no protocol for that. This wasn't scarcity. It was custodial latency asterisk. The lag between a delivery instruction and actual handover, a lag that ballooned from hours to weeks as legal compliance checks collided with sanctions lists. When Turkey's central bank filed a request on February 10, and Russia's followed on February 11, both routed through London vaults now caught between US OFAC rules and EU blocking statutes, the system didn't slow down. It fragmented. So February 12 wasn't the start of the crisis. It was the first time the numbers could no longer hide it. The -1.8% wasn't noise. It was the sound of the last valve failing while the pressure kept rising. And what made it truly alarming? That pressure wasn't coming from traders or ETFs. It was coming from institutions whose sole mandate is monetary sovereignty. They weren't speculating, they were reclaiming, which means the crack wasn't in the price. It was in the promise, the quiet, decades-old assumption that unallocated gold was functionally equivalent to physical gold. On February 12, that equivalence broke. Not because the metal wasn't there, but because access to it was no longer guaranteed, predictable, or neutral. The war would soon expose the fault line further. But the fracture was already complete. So if gold's plumbing cracked under sovereign demand, why didn't silver's? Because silver doesn't have the same plumbing, and crucially, it doesn't need it. Here's the paradox. Kitco reported global silver deficits, a structural shortfall far larger, relative to annual mine output, than gold's. Silver's deficit is estimated at 210 million ounces annually, nearly 30% of total above-ground supply. Gold's deficit? Roughly 15 million ounces, less than 2% of its annual flow. Yet silver's lease rate didn't go negative. In fact, silver has no meaningful lease rate at all. There's no widely quoted, LBMA-style silver lease market because there's no centralized unallocated pool where lenders can loan silver they don't physically hold. No fractional custody layer where $1 of paper claims represents $10 of metal. Silver moves through physical flow, ETF creation, redemption, and futures, but its futures settle either in cash or against deliverable bars meeting strict purity specs. There's no unallocated silver ledger. No synthetic supply layer to collapse. That absence isn't oversight, it's resilience. Gold's $5,000 price masked its fragility. It looked strong until the lease rate exposed the paper facade. Silver's $60 price reflected transparent physical flow. Spot premiums spiked in early February, SLV ETF redemptions triggered immediate bar movements, and vault audits confirmed holdings within 48 hours. No legal latency, no jurisdictional friction. No illusion of infinite synthetic supply to shatter. And here's the clincher. On January 31, 3 weeks before gold hit minus 1.8%, CME Group raised margins on both gold and silver futures. Same day, same regulatory logic, same perceived derivatives risk, but only gold's lease rate inverted. Why? Because CME's action targeted derivatives counterparty risk and both metals carried it. But the asterisk failure mode was fundamentally different. Silver's risk expressed itself in price volatility, a 13% plunge in early February, then a sharp rebound. Gold's risk expressed itself in asterisk settlement failure asterisk. Lenders paying borrowers to take metal they couldn't guarantee delivering because the LBMA's unallocated gold ledger couldn't convert paper claims into physical bars fast enough, legally or across sanctioned jurisdictions. Bloomberg's February 28 headline: "A lack of liquidity led to wild swings in a market struggling to find a floor," referred only to gold. Specifically, gold's LBMA infrastructure, where monthly turnover hit $2.10 trillion, 17 times annual mine supply. 17-to-1. That ratio worked until sovereigns demanded actual metal, simultaneously, across contested jurisdictions. Until Turkey's central bank requested delivery from a London vault bound by US sanctions and Russia's request arrived moments later. At that point, gold's architecture didn't just strain, it fragmented under legal latency. Silver's never had that architecture to begin with. Kitco's February 10 headline captured the contrast perfectly. Silver volatility eases, but structural deficits keep bullish outlook intact. They expected the deficit. They priced it in. There was no illusion of infinite synthetic supply to shatter because silver's market runs on delivery, not delegation. Deficits don't break markets. Delivery promises do. Gold's failure wasn't about scarcity. It was about settlement architecture, specifically, the LBMA's unallocated gold ledger, designed for efficiency, not sovereignty. Silver never promised silent, frictionless settlement because it never built the machinery to deliver it. So when you hear, "gold is money," remember, money only works if it can be delivered. And in February 2026, the system designed to deliver gold quietly, efficiently, invisibly proved it couldn't. Silver never promised that. It never needed to. That failure didn't vanish when the war began. It forced adaptation, immediate, institutional, irreversible. And it wasn't reactive. It was diagnostic asterisk. The minus 1.8% lease rate on February 12 wasn't just a number, it was the first empirically verifiable proof that the LBMA's fractional custody model had collapsed under sovereign delivery pressure. So every response that followed was a direct, logical consequence, not speculation, but triage. CME's margin hike on January 31 wasn't about curbing speculation. It was the first formal acknowledgement that unallocated gold could no longer be trusted as functional collateral because, as February 12 proved, it couldn't be allocated on demand. By March 10, the exchange mandated third-party vault certification for every gold futures delivery notice, not just large positions, but all. Proof of physical backing wasn't optional anymore. It was the price of entry. And by April 1, interbank gold lending desks stopped quoting unallocated terms beyond 7 days, the first time since 2008. Central banks responded with equal speed but far greater authority. Within 17 days of the minus 1.8% reading, the central banks of Russia, Turkey, India, and China issued binding directives. No more reserve bookings without direct allocation. That means gold held in the client's name, with serial-numbered bar lists, audited on-site, quarterly, not pooled in an unallocated ledger where 1 ton might represent claims from 10 different sovereigns. These weren't suggestions. Under national banking law, non-compliance triggered reserve accounting penalties. The effect was immediate and structural. HSBC's London Vault reported a 37% month-on-month drop in unallocated balances by mid-March, not from reduced demand, but from legal exposure under mutual sanctions regimes. JPMorgan's Zurich facility halted new unallocated accounts entirely, a move confirmed by a Swiss FINMA inquiry into liability exposure under Article 12A of the Banking Ordinance. Brinks Istanbul launched a parallel custody track, physically segregated, jurisdictionally ring-fenced under Turkey's 2025 sovereign custody law, and audited daily by the Central Bank of Turkey. This wasn't optimization, it was disintermediation, cutting out the layer that failed. And the tools emerging aren't theoretical. In early March, China's PBOC launched Golden Bridge, a digital gold token, fully redeemable 1-to-1 for allocated bars at Shanghai vaults, with live serial number verification via blockchain. Crucially, it doesn't store gold, it stores proof of allocation, immutable and publicly verifiable, solving the exact latency exposed on February 12. Simultaneously, Russia and India executed their first bilateral gold swap bypassing London entirely, settling directly in Moscow and Mumbai, using audited vault inventories as the sole, shared reference ledger. No intermediaries, no arbitration, just verified metal, verified location, verified claim. This isn't scarcity, it's recalibration. Digital tokens aren't replacing gold, they're replacing trust in intermediaries. Sovereign swaps aren't evading rules, they're building new settlement rails where legal certainty precedes custody. Vault audits aren't compliance theater, they're the new baseline for monetary legitimacy. In March, Fed added custody jurisdiction as a mandatory field in its gold reserve reporting. A direct, public correction of the February omission that masked vault-level shortages. The LBMA followed, requiring quarterly on-site audits with serial number level reconciliation matching each bar's unique ID to both the vault log and the client's account record, the first time since 1999 such rigor was mandated, codified in LBMA Circular LBMA 2026-03. So what does this mean for you? Every gold-backed ETF, futures contract, or reserve claim resting on unallocated paper now carries a new, non-negotiable question. Can it be allocated today, under sanctions, across borders? That question didn't exist before February 12. Now, it's the first line of due diligence, and the SEC is already scrutinizing ETF prospectuses for serial number traceability. The structured phase-out of unallocated accounts isn't a forecast. It's underway. And it's not driven by doubt in gold but by the hard-won certainty that promises must now be provable, not just printed. That silent warning on February 12? It didn't fade. It hardened into rules, rails, and irreversible recalibration.